Hi, everyone. Thanks for joining us. We're just sort of watching the participant list climbing. So we're waiting for enough people to get in. We had a whole host of registrations for this. So just making sure that everybody is able to get in. I think that number is now up to 90. So we'll wait a little bit for everyone to get in. Okay, it's about 3 minutes past the hour. We have like 125 people on the in the audience. I think we'll get started. So hi everyone, my name is Vikram Vedhyanathan. I'm a partner at Matrix. I've been leading venture investments here for the last 12 years. Been an early investor in financial services and sort of fintech. So welcome to the panel. Just a quick introduction to what we're doing here. We've been doing the State of the Fintech Union periodically, and we sort of coined it as Soft 2. And this time around, our partners at BCG have been helping us through the process. They work incredibly hard, so thank you. And what the process that we followed so far, and we sort of added to it this year, is that we usually start with a survey that's sent out to, call it about 150 to 200 market participants across the fintech ecosystem. Some of these are fintech founders and CXOs. Some of them are people in banks, as well as the regulator, as well as insurtechs and Amphi and so on. So that's the set of people that we survey. There's some data that we have from that survey, which we are looking to unpack. We layer on that data with insights from actual financial services and fintech practitioners, and you see a bunch of them here today. So our objective in this panel is to unpack some of the data, and some of it is super interesting, and some of it is surprising, and we'll get to see it from the lens of people who are actually leading companies in these spaces. And our final output would be a report that we sort of give back to the ecosystem and will be shared with everyone publicly, as well as hopefully some points of view that we can present to incumbents and banks as well as regulators. So that's the initiative. I'm Vikram, I'm from Matrix. I'm going to hand over to Vipin, who's leading the BCG team and is going to serve as a moderator on the panel.
Thank you, Vikram. So like Vikram introduced myself, I'm a partner with BCG, and I'll be helping moderating this panel today. So before I get into some of the insights which Vikram was talking about, let me take the privilege of introducing all our panel members. So we have a very, very esteemed list of panelists today. So let me start with Lizzy. So Lizzy Chapman is a CEO and co-founder at ZestMoney, one of the largest BNPL and one of the largest and oldest BNPL players in India today. Second, we have Padmanabhan Balasubramanian, called as Paddy. He is basically a partner with Protium, one of the, again, new age NBFCs focused on MSME sector. We have Ruchi Kalra, who is a co-founder and CFO at OfBusiness. We also have Sumit Maniyar, who is founder and CEO at Ruchi. And lastly, anyway, he has introduced himself. So these are the 5 panelists we have. So like Vikram mentioned already, so we have basically done a long survey as well as one-on-one conversations with close to One, are you able to see my screen? Sorry. Okay. Is my screen visible now?
Yeah.
Okay. So we surveyed close to 125 plus industry leaders across fintechs, banks, insurance companies, spread across all segments, including lending, payments, insurance companies, and so on and so forth. And most of these folks were either founders or CEOs or CXOs or business heads at one of these organizations, right? Now, what we want to do is over the next 4 to 5 minutes, I will share some of the key insights with all of you, which will basically set the context for our discussion going forward. And the longer insights or the longer list of insights, etc., will be part of the reports, which will be shared separately. So let me get into details now. So I think one of the things we wanted to understand from all the fintechs were what are some of the top priorities for them, which keep them awake in the night, right? And what we heard from most of them is that 3 things are critical, or what are top priorities for them. One is product expansion. Second is hiring the right talent, and geographical expansion. And I'm sure for all the people, all the fintechs founders who are there on the call, plus most of the audience, I'm sure points 1 and 2 are not surprising. The talent is obviously one of the top of mind issues for everybody. The expansion is top of mind for everybody. But what is interesting, or what got our attention, is what are some of the points which they didn't mention as important. For example, fundraising was not a top priority for most fintechs at this point of time. And secondly, cost reduction. While most of the fintechs are talking about profitability, etc., cost reduction never came up as a top priority. So that is something which is interesting, and interesting observation, which we would want to hear from some of our panelists why that is the case. And on the right hand side, the other important thing which we found is most of the innovation and the disruption which is expected is on the unsecured space, unsecured lending space. So while if you look at Indian asset market, large part of the market is still in mortgages and SME lending. Maybe 50% of the market is in mortgages and SME lending. While there is limited, or while that is the case, there is limited focus in terms of innovation on that front compared to that of unsecured space. And that's where some of the panelists like Ruchi, etc., Ruchi and Paddy can obviously share some of their perspective in terms of what's happening on that front. Moving ahead, I think in terms of regulatory aspects, I think there are a couple of points which most fintechs felt were top of mind for them, more from an impact on business continuity perspective. One was the recent RBI draft guideline on restricting FLDG models for non-regulated entities, and similarly some ambiguity in terms of regulations related to BNPL models. And both of them were the concerns are not along whether it's good for the industry or not, but more from a business continuity perspective, or how it's going to impact the business continuity for many of the fintechs in the market. Moving ahead, I think the third part which we wanted to cover is about the sustainability of the business itself. And typically what I've seen is most of the founders we speak to on the in fintechs, most of them are very optimistic about their business models. But what's interesting to see is most of them, at least 75% of them, did not feel that their businesses will become profitable over the next 2 to 3 years, which is a very, very drastic number to see, right? And this is a self-reported number. So I'm a founder, I'm saying that I don't believe that my business will become profitable over the next 2 to 3 years. So what's worth pondering is that because the business model itself is not viable, or it's not robust, or is it because they are continuing to focus on customer acquisition or a merchant acquisition at the expense of profitability? So that's something which worth pondering, and we'll get some perspective from our panelists today. The other side, other 2 points which came critical is the 2 key concerns which led to them to believe that the business will not become profitable. One was the asset quality itself, and second is the cost of customer acquisition. So we'll deep dive into some of that as part of the panel discussions. The other part which is interesting is there are almost 20% of the fintechs who felt that, or who have at least shut down or scaled down some of their business over the last couple of years. And a majority of them were in the unsecured space. And the reason for that, again, is on the asset quality side. So it's simple. If you read all these messages together, what it looks like is asset quality and customer acquisition cost is actually leading to non-profitability of most of the fintechs. Now, the last part I want to cover is the recent regulations related to credit card as well as the PPI lending. So I think most of the fintechs at least see this as a positive outcome for the industry, where they feel that this will definitely help in better credit card penetration in the market. And many of them are interested in actually applying for a credit card license and entering the market. With this, let me stop the presentation right now, and let me pose a few set of questions to our esteemed panelists and get their perspective. So let me start with Lizzie first. Lizzie, as you already know, India is one of the most advanced nations globally in terms of payments, and even Economist has congratulated India on that front. But if you look at lending side, India has not been able to make that kind of a mark so far, right? While we have few players like you who have achieved still scale, but we are still far away from the kind of mark we made on the payment side. So what we wanted to understand is, as an industry, what do we need to make India amongst the top league in terms of lending?
Yeah, great question. There's a few points related to this topic, but it's very pertinent and relevant to the current environment. I think actually many ecosystem players and maybe even the government and regulator have been surprised by the phenomenal runaway success of a platform like UPI or IMPS. And as you said, it's been something the world has taken note of, unobserved. It's a truly sort of black swan event to create such a successful technology product that has had such fast adoption. And that has powered the way for so many other innovations and improved the lives of many of our consumers and even our businesses, because, for example, as lenders, many of us can collect money more easily, et cetera, et cetera. So it's been this phenomenal movement in the ecosystem. It's not fair, though, to compare the rise of UPI to any other segment of the fintech landscape, because it's a very, very unique phenomenon that was designed to drive infrastructure build and financial inclusion. When we look at lending as an ecosystem, it's a much more complex and diverse ecosystem. And there are many, many unique challenges to building a scaled lending business. Nowhere in the world do businesses get built in lending as quickly as they do in payments or any other kind of rails. And that's because ultimately it's a business of doing risk and taking risk. I think, and I hope we have a bit more of a deeper conversation about this today, but I think one of the biggest challenges all lenders face in this country is the evolution of the capital markets as they sit today, and therefore how we fund and fuel lending businesses, not just cheaply, low cost, but even efficiently and at the volumes and scale that this market requires. So I think everybody here would agree that the demand for credit from the SME, from the consumer, from the enterprise is absolutely insatiable. We probably have one of the highest demand quotients in the world, but the supply of risk capital is very, very challenging in this market. And all of us operate with that backdrop. And that's not necessarily a bad thing in the early days of a fintech build out, because we've developed very interesting innovation and infrastructure to try and solve that problem. But I think what you're pointing out quite eloquently is that few of us have scaled yet to the scale of the size of the demand. And to meet that demand scale, we need a much more evolved funding landscape. And whenever we talk about funding in this country, people think of equity, but there are many, many, many other forms of instrument that fund, especially lending businesses. And I hope today we can talk about that and why that needs to be the next leg of growth in order for all of us to scale to the potential and the impact that we can have as an industry.
Sorry, I'm just gonna chime in there. And for me, it was super interesting. The largest priority was actually geography expansion and product expansion, and
not cost reduction. I saw that. Yeah.
And I was thinking about why that is, right? And when I think about the companies that I'm involved in, that is what we are looking at. And to me, what Lizzie said, which is actually it's scale that matters, because as fintechs, we've invested in fixed costs upfront, especially in technology, to build a platform, and that platform works at scale. And I think a lot of companies have figured out actually how to make money at in a pocket, but what will help sustainability and profitability is actually if they get to meaningful scale. And I think the discussion around profitability should be fixed to, or at least for me, is more meaningful to figure out what does it take to get enough companies to meaningful scale? Because then we will see sustainability and profitability. And one of those barriers to scale is the credit markets, like Lizzie said. And I'd love to hear from others if they think that's the right interpretation on what sort of blocking profitability for multiple fintechs. And I know some of you guys are already looking at profitability, maybe more so than everyone else.
So maybe Paddy, you want to go ahead from my SME perspective? How are you thinking about it?
From a SME perspective on funding or
lending. I was talking lending, SME lending.
Yeah. So I think if you stick to the theme of what we wanted to achieve today, there is innovation in fintech and the regulatory aspect of it. I'll focus first on the innovation part. And some of the panelists talked about UPI and payment. And one of the key observations from that is consent-driven architecture for doing KYC, doing payments, doing anything where there's a consent architecture. And I think as a country, we have excelled in that when it comes to payments or identity. Having an ability to do consent-based data is actually a very big innovation that we will have to focus. So if innovation in technology or process can change the price point at which I'm able to serve a customer at scale, then that is true innovation. If it is somewhere in the realm of arbitraging a regulation, then I don't think it is actually an innovation at all. So if we can build innovation at scale, and I think consent-driven architecture is one example of innovation at scale for data, where I as a lender can have access. I know the government is making efforts on AA to get banking, but that's just one piece of information. There is GST, there is maybe Provident Fund. So if consent-based data becomes a prevalent theme, lending at scale is possible. And the innovation there is actually quite powerful for reducing the price point without touching any regulatory arbitrage that might come on the way. So to me, that is a key theme that the country needs to focus. And I'm confident that there are grassroots level initiatives that are already there for that. We'll come to the asset part a little later when we get a chance to talk about secured part. But if I talk about data, I think that is a key area of innovation, and consent-driven architecture is a key pillar of how the data becomes democratized.
Thank you, Paddy. Sumit, I think on the asset side, I think you have been, or Rupik has been one of the top innovators in the gold loan space compared to, or if I look at any other asset class, you have basically ensured that you've brought in innovation to a sector which traditionally has been dominated by a few NBFCs, right? So what are some of the learnings from your side? What helped you scale your business?
I think secured, unsecured, if we take a step back, we have to also look at as a country where our strengths lie. The key insight, this was RBI's household finance report of 2017, where it stated that at a household level, we have huge part of our household wealth tied in physical objects. Think of your maternal, paternal cousin in a tier 3 city, typical family gathering. You'll find that the talk of the town is that they have bought land, they have gold at home, they're buying vehicles, and 5% goes into mutual fund, acha hai, and your FDs and whatnot, which surprisingly is the highest percentage of physical asset ownership at in the entire world. And paradoxically, as a country, we are all thinking about, we have the lowest secured credit penetration in the entire world. Of a country of this size. This is just mind-boggling. And what we're trying to do is we're trying to discount future cash flows, assess through different means. Don't get me wrong, it's important. It's very, very important. But when you look at a nation's need for credit, there has to be something, meaningfully needle moving in the asset side as well. Now, gold is just a tiny part of it. Mother of all is, real estate mortgages. And the biggest insight has been that there is a bountiful opportunity which is very India specific, and nobody is looking into it. And I think will require probably thousands of startups and tens of SBIs and Bajaj to come together to monetize this dead asset, whether it is gold, whether it is real estate, whether it is motorized vehicle. And that is probably very India-centric approach, and no other nation, because this kind of paradoxical behavior is not present in asset and liability at no household of a global comparable nation. We have to solve this problem. Otherwise, imagine how much unsecured credit would be required to replace that secured credit. Mind you, the IRRs required to hit that would be higher. Quantum will be lesser. So as a nation, we have to take a holistic approach that we need credit. It doesn't matter where it comes from. Now, if some of the innovations which are path breaking, and I think those are very important, like consent-based architecture, one of its kind, truly innovative, that will open up unsecured. But we should also look at a holistic approach. Now, where I think currently the landscape is that there has to be more reforms pushed in other sectors for the asset-backed lending to really click. For example, the title ownership of properties. In case of gold, legal ownership, it's still in gray area. So there are a lot of reforms which are prerequisite for the other sector. Unfortunately, some of the states have been innovating. You have Maharashtra, where they call it Satbara, where the agri land is even digitized, records are put on. Andhra is doing something, Tamil Nadu is doing something. So these are some, I would say, micro reform, not a macro top-down reform, which are coming in. But these will stack one over the other to make sure that these categories open up for disruption. Unfortunately, India is a highly competitive space. Wherever there is juicy IRR available, you will find the incumbents will also come and attack. But I kind of agree with Paddy's view that these reforms which are being pushed, I would say innovation/reforms, really would open up opportunity to create new businesses in a sustainable way. So, I mean, we are also on the lookout. Happy to learn from everyone.
Yeah. So coming to Ruchi, I think you guys have started some work around lending to SMEs based on cash flow basis, rather than looking at maybe purely unsecured. So any learnings or any thoughts you can share in terms of how do we attack this large MSME market?
Yeah. Thanks, Vipin. I think I'll answer that question in context of what Lizzie and Vikram both brought up. The first theme was the profitability part that Vikram was bringing out, in terms of saying that when more and more fintechs are scaled enough and profitable, then suddenly there's a different view to the sector. And that's, I think, a crux of it. And if we look at our own journey as Oxyzo, we currently, as a fintech or a tech-enabled NBFC, we currently at a pre-tax ROA of 5% plus, right? And which is actually growing year on year, because we decided that it was very important for us to. And when we are currently serving a segment which is a sizable SME, which was more tuned to the heroes or the ABFLs of the world, wherein someone was offering at a 15-16%, and going back to Lizzie's point as well, that if so that we could actually get the cost of capital to a point that we can address that particular cost segment, right? And an important thing, at least I have seen evolving, is, and Sumit touched upon the asset classes, asset back. Many a times a fintech is pushed, even if they have a broader vision, pushed to create asset classes such that it is palatable for a bank. So a bank will buy it, or it can be securitized in the market such that there is access to cheaper cost of capital. And I'm sure Sumit would have experienced this with Rupeek. There is demand because of what their asset backing is, right? And in all this, unsecured, it's like, okay, maybe the bank does not want that unsecured portfolio. And hence there is that clash or misalignment, so to say, to say that how can actually fintech get access to a cheaper cost of capital. I think if from the start itself, we are very sure as to how we want to use the technology. In the sense, in our case, it's a fast rotating capital. We do working capital every 3 months of redeployment, cash flow based, product per se. So hence we have to use the technology effectively there. Second is, how do we use it in terms of getting all the data together and access to data together, even though we have some physical presence, but how do we optimize it to actually ensure both the cost of credit, as well as any credit cost associated with losses is lower, and hence the overall quality of portfolio is good. So I think the objectives are clearly out there, even in your survey, that if you get the basics right in terms of controlling your costs on OpEx, if you get your credit quality right, and if you are very clear of what that product combination is, whether the bank wants it or a very large NBFC wants to take your portfolio or not, but if the quality of asset is good enough, and proven even over a year, 2 year, 3 year track record, then profitability is something that you've planned from day one. It is not a post facto thought. And the only thing I actually often disagree with people who actually write a lot about fintechs is fintechs doesn't mean that it's out there to lose money. They are trying to innovate, put the costs ahead, invest, so that in the long term, maybe the risk costs are lower, or in the long term, they're actually able to service a segment at a much lower cost. Everybody could have their own objectives. Every type of fintech could have their own objectives. Some invest upfront, and some could invest as they're going. But the rules of the game are simple. You do it clean, you do it with the right operational cost, you do it with the right credit costs in terms of defaults, and automatically the cost of capital will keep coming down. It's just that you have to find where your objectives align to a different a part of the financial services ecosystem where you can get lower cost of capital. So those would be a few of the learnings from our journey, actually.
So I think if I were to quickly summarize, I think 3-4 pointers we heard from across all of you. One is the most important point all of you mentioned is the funding landscape, or the evolution of capital market itself. How do you reduce the cost of funds so that you can compete with the traditional NBFCs and banks? That's point number one. And secondly, like Vikram mentioned, a lot of, or the basic premise or basic requirement for a fintech to be profitable is scalability, or scaling basically, because you're invested quite a bit of amount on the technology as well as infrastructure to ensure that you can scale up the business multi-X. Unless you reach that stage, obviously the OpEx is going to be higher for you, right? And the third point, which I heard you mention, Ruchi, is on the asset quality part of it. So I didn't hear others mention that. So maybe Lizzie, what do you think about the asset quality, especially considering that there's a lot of unsecured lending? What do you consider asset quality as a main reason for lack of profitability with fintechs today?
It's not the main reason, and I think we need a much longer discussion on profitability and how we all become profitable, but it is a very key lever. And I think if you had to ask me what is one of the kind of shortest cut, quickest hacks to profitability, the answer is very boring. There isn't one. It takes time, and it takes time to build risk models that perform through every different cycle, different phenomenon. There's that kind of glib thing, I can't remember who said it first, but you can't create a baby by throwing 9 women at the problem in 1 month, right? And lending is a very similar phenomenon in that everybody gets paid monthly in this country. Lending cycles therefore have a certain finite time period. Even if you speed everything up and throw billions of dollars of capital at lending to a human being, you can't change their behavior, and you can't change that cycle of repayment. So that 30-day kind of knowledge period is consistent for everybody, no matter how fast we run, which means it takes time, and it takes time and patience and continuous focus and continuous improvement. And we've been doing really the same product with very little change for 7 years, nearly, to a very similar target segment, to a very similar, we have not changed much in 7 years, but every single month, every quarter, our risk performance has improved multifold. And that's just because we keep doing the same thing again and again and again. I remember asking Jay from BillDesk, who's one of the best fintech founders in this country, what's the secret of creating a really valuable business in a market like India? And he said, just wake up every day and do the same thing better. It's very boring. It's very, very hard to sell that to VCs, Vikram smiling, but it's unfortunately what defines an HDFC versus X number of banks that didn't make it, what defines a Bajaj versus 100 consumer durable competitors. They just consistently improved underwriting. What I would say is though, there's really a very strong argument that fintechs can do it better. And that's because number one, they can learn faster. We use machine learning models that obviously learn much, much more quickly than a human being. We can update our models every hour. They are real time. And we saw that during the pandemic. Our models were literally changing minute by minute as they saw stress in different regions, different employment segments, et cetera, et cetera. A traditional underwriting model would not be able to react that quickly. There would need to be a manual review process, new rules written, and that takes time. And that means credit costs would be higher in a very stressed scenario. So I strongly believe that technology applied to risk modeling is an enhancement and can speed up that learning process very quickly. And then, secondly, as fintechs, we tend to be very, very good at building customer-centric products and product experiences. And we saw during the pandemic how powerful that was in reducing credit costs in a difficult environment. By being able to personalize the product on a per customer basis and give personalized offers, repayment and collections, personalization, et cetera, we could create a much happier, much more loyal and much more well-behaved customer base than an incumbent that had to use much more broad brush offline or physical collections practices. So that's just two examples. There are many, many reasons why a technology company can crack it faster and better, but it does take time, it does take focus. And the more kind of products and pivots and new stories a company tells every quarter, the harder it is to build that discipline in risk underwriting, I believe.
Thank you, Lizzie. So I think we need to go deeper into the debt market part of it. But before that, one last question on this topic to the rest of the panelists. Do most of you believe that fintechs have mastered the art of underwriting the ski customers, especially the NTC kind of customers many of the fintechs go after? If you don't believe so, then do you believe that you need to put, or the fintechs need to put more efforts on building a strong collection capability, which normal NBFCs and banks have today? So, I mean, I don't have I'm not posing it to anyone specifically.
I'll answer that question differently. And, I obviously have a span of fintechs that are across the portfolio. I think the one notion that I actually want to dismiss is that fintechs don't care about asset quality, right? If you ask any financial services fintech founder, that's the thing that they all care about, right? Now, I think over the last 3-4 years, everybody's got a crash course in how bad things can get with the pandemic and so on. So the fintechs that have sort of come through are truly crisis tested. So I think today the fintechs that are around actually have collection practices which are on par with financial services companies, layered on with some of what Lizzie said, which is they do sort of contactability differently, they do traceability differently, right? So it's the same practices and the same words that a financial services company would use, but they just do it differently with potentially less people. And in some cases, you do have to throw a lot of people at the problem. And I think pretty much every fintech has learned that. So I know that in the early days, there was this maybe perception, but definitely potentially even a reality that there was more focus on product innovation and less on asset quality. I will say that is absolutely not the case anymore, given the number of crises that every fintech has sort of faced.
on equity is. But if I'm a debt investor in my own company, I care about the stability of asset quality, not just the quality on a particular year, but the stability of, and if I'm giving a 1-year term paper to myself, at the end of it, I need that 100 rupees back, my principal back. So I think ability of a debt investor or interest of a debt investor are significantly different than the interest of an equity investor. And as fintechs and as market participants, as much as we are able to create valuation and equity returns, I think we have a strong obligation to create the right incentive for a debt investor to actually invest in the right places, which means your asset quality is already baked into your business projection. So when you actually underwrite and when you say your profitability metrics, it's already baked in because that's what was your going in assumption when you were creating your ROE tree, right? In some sense. So being able to actually deliver the numbers is more paramount for someone who's giving you a term funding for 1 year, and profitability, as Ruchi said, matters to a debt investors because that's what is going to actually get returned within a 12 to 24 month period. So I think it's important for fintechs to understand that the liquidity in the debt market is a function of parameters which the debt investors look at. And being able to prove that you have those metrics on a consistent basis is important for all of these things to get opened up. I don't think we are there yet, but it's also important to ensure that we actually get those metrics for a debt investor.
I think almost all of you guys have mentioned that, this a vibrant debt marketplace is sort of a significant long-term enabler to scale. And Sumit, you were talking about some of this sort of early on, saying, if I get different access to capital, I can serve a much larger market and so on. And maybe set that up for us. And I know Ruchi and Oxyzo have built a platform which can sort of enable it. So I think we can take the discussion that way. But Sumit,
this, this is something which I had heard from Uday Kotak himself, and it stayed with me. It was a beautiful problem statement. He said, look, obvious in hindsight, like any good insight, where he said, look, what really is going on is in lending, you would select a high quality borrower and find inefficiency for them, whether it could be pricing or process, and try to disrupt that. You will never go towards a crappy borrower and then cater to them. Now, that was a very, I'm actually, distilling of a couple of thoughts here, but essentially this was his view that you need to stay honest. You cannot, because a crappy borrower is an outcome of several things, intent and the macro factor. So you need to first select the good borrower. What is the definition? Now, barring those, as innovation and reforms, which actually enables the discovery of the good borrower who are not in the system, barring those new gen cases, what he essentially was trying to say was that for the good borrower, the sacrosanct thing is the low cost of fund. Now, as long as you have access to low cost of fund, you can sit customer's place and look at all the inefficiencies which that customer is being penalized for. It could be higher rate, worse turnaround, lower LTVs, lower quantum of loans, so on and on and on. Now, interesting thing which I, in hindsight again, I have learned is that in the good cycles of credit, you get access to cheaper debt. Everyone gets access to relatively cheaper debt. And with the credit tightening happens, you are forced suddenly the debt market, because they're not mature or they're not highly efficient for lower cost of fund or pricing the proper risk. Then as a fintech or a new gen player, you're always tempted to walk towards a segment of that crappy borrower. And what happens is, in that one cycle you might survive, two cycle you might survive, but then it will come back and hit you at scale. And that's the biggest problem, which is an outcome of a inefficient this thing. And look, I mean, we are ultimately, whether founder, management, we are all driven by greed and fear. So the discipline to not go into that territory, trade-off growth is always going to happen. It's not about underwriting, because again, it's not a rocket science at all. I mean, this was the first thing which machine learning was supposed to do in 80s, right? There is no rocket science there. that's the key of it. That's the problem statement at the heart of it, that we as in the entire ecosystem needs efficiency on debt market side, whether you get on balance sheet, off balance sheet, through securitization, through public deposit, through commercial paper, NCDs. Instruments could be tens of them, but without that, there will always be a fundamental disadvantage to all fintechs in the country, or even NBFCs, or anyone who is trying to get access. That's why you will see the Pareto, once you attain a certain escape velocity, your access to cheaper deadlines emerge, and it just compounds from there on. So that's the key in order for the sector to prosper, and that could probably be the context for discussion.
Sorry, Ruchi, and given a little bit of context on Oxyzo, I'd love for you to chart your own journey, because I know you guys have started the rating journey very early, and I've ended up at A rating pretty quickly, and just chart your own journey on how you get up at the rating. And second, now there is high discoverability of A and onwards rated paper, and as soon as you get to the territory, that's it, right? There's just no discovery, either corporate treasury or retail. And what do we need to do as an ecosystem? And I know you guys are doing something to actually make sure there is enough discoverability of new sort of debt instruments and it getting plugged into retail and corporate treasury.
Yeah, I firstly completely echo Sumit's sentiment in terms of actually availability of capital. And if you look at, the history of new NBFCs which have come up, and this is something that we often discuss, you always find that an NBFC is bucketed, if it's new, in terms of trying to go in for a credit which is around 25% IRR. We never ask this question, why is it so? The point is, first of all, there is an initial investment in terms of OPEX, but more importantly, it is that cost of capital. If you're getting that at 15, you cannot lend at 17 or 18 because you have operating costs associated with it, right? So I think Lizzie also mentioned this, Sumit mentioned it, that having a level playing field is very, very important, because innovation strives only when you actually have other parameters worked out, right? And that's when you actually have an ability to choose. In our case, because we were always focused on the sizable SME, so as to say, which was banked, right? And if you were slotted in that, it was for us to get to a scale faster, start our rating journey much easier, engage. And for us, the way we said it is that an NBFC which has been in the last 4 years, who's seen all cycles from an ILFS, DHFL, DMON, GST to COVID, has gained enough what an NBFC would gain in 20 years of operations, right? Those 5 years have taught you how to survive like any NBFC would have been of a vintage of 20, 25 years, right? And if you really believe in it, and if you've seen the credit cycles, as what Lizzie was also explaining, you get smarter with each of these cycles. For us, these cycles were like 3 monthly cycles, because we had put down a product which NBFCs were not doing for SMEs, which was actually cash flow match product to buy raw materials, right? That's the core product, which is like 75-80% of our portfolio, which is like a WCDL line that the bank gives, operates like a CC, and the payment is always made to the supplier. And there was no such availability of product. And if we had to do it in the segment, there was no other option than actually going in for reducing our borrowing costs. So first line for us was, we will have as many lenders as possible. We borrow from 50 institutions, right? And this is in addition to all the CPs that we've raised. People said that at a 400, 500 crore scale, you cannot have listed MLDs, you cannot have, listed instruments, it was new for doing the level of, different product combinations we were doing at that. But we went in, we experimented, we pulled out portfolios, and to what Sumit was also saying, there are a lot of instruments available, but to actually focus so that you can actually have the maturity in each of these instruments very early in your journey actually helps. And that combination of focus on liabilities, combination of focus on asset quality, and then at the same time growth, it's all a balance as we do innovation, actually helped us going back to the rating agencies, the performance in COVID, when we showed that, yes, we could maintain a great asset quality. Sorry, I'm mentioning asset quality again and again because of this perceived notion that fintechs don't care about asset quality. And that's not true. On the basis of that, we've got multiple upgrades and actually got to an A+. with the leading rating agencies. So that's been our journey, which has actually helped us to reduce our borrowing costs. And to Vikram's second point, we believe that there's always a seeker of return and a provider, means a seeker of capital and a provider of capital, wherein that IRR matches. And even though we've talked a lot about lending here and a little bit about payments, fintech has actually also changed the landscape in terms of wealth, right? An individual can go online and invest in a bond of a fintech and get a 9%, 10%, 11% return, right? And that has been possible because of the tech ecosystem coming together. And what we are also aiming to do is that there are various structures wherein assets can be, to Lizzie's earlier point, you bunch up the assets together, you put in the right kind of enhancements along with it, make it available as a structure which is reliable and rated for an investor, which could be of a different type, whether it's a treasury, maybe it's not a bank treasury, but maybe it's a corporate treasury, or maybe it is, for that matter, even a retail investor or a bunch of HNI investors, right? And if you build that full ecosystem, which many entities are trying to build today with the intervention of technology, I think this is a problem together as an ecosystem we are solving. And with the articulation that's happened in the panel today, I think it's even something that many people will even go towards solving more. Lizzie, maybe you can add to that.
There's only one point I just wanted to quickly bring up because we haven't mentioned it yet, and it's very relevant in the context of asset quality and profitability, which is something that fintechs are very, very good at. I think all of us here participate in this, which is risk-based pricing. It's very challenging to do adequate risk-based pricing for an incumbent using a traditional distribution model. And in a market like India, I would argue the ability to price risk effectively and then package and segment and fund that risk is probably a superpower, because this is such a diverse market that we're all operating in. There is no single consumer, there is no single SME. The type of regional variation we see even in GDP per capita is more diverse than you see between Latin America and Europe. And so to be able to understand who and what you are lending to and how you price that appropriately, given the other options in the market for that customer and what risk you can take versus that pricing, is extremely powerful. And I think if you had to say what's one of the key levers that will create scale and profitability, it would be having the ability to price risk effectively. And I do believe that fintechs are much, much better placed to develop that superpower than an incumbent. We're all building from first principles. We have the technology systems and frankly, the depth of understanding of our target segments to do that more quickly, in my opinion. I think most of us here do risk-based pricing to some extent, and that is a big driver of future profitability.
So shifting gears, sorry, Vikram, go ahead.
Sorry, Lizzie, I know before we were talking about, the development of these debt markets globally, especially, people like Goldman, Morgan, sort of putting these bundles together, which then leads to an explosion of potential risk-based models on the demand side. Right? Are there constraints today in the India ecosystem that prevent that vibrant debt marketplace from taking off?
Yes. So I think Ruchi mentioned something very important, which is that the demand is coming on the investment side, right? We're seeing that now, certainly from private investors. We're starting to see some aspects of the traditional capital markets adapt and understand these instruments. It's just very, very, very nascent, very early, and we are missing entire segments of that ecosystem. So if you actually look at who are the last mile funders of a lot of particularly the US fintechs, it's hedge funds, it's credit hedge funds that play in this space. We don't have them yet in this country, and there are obvious regulatory, SEBI-driven reasons why we don't have sort of credit traders per se. It will come, and you're starting to see global credit funds look at India. but the FX costs, obviously, of getting fully landed capital are challenging. There's a lot of innovation happening. I am excited. I think the biggest regulatory shift we need is in the securitization norms. Massive evolution is needed there, because it's not just about the ability to do this. We can obviously securitize. It's about how we can create high velocity throughput, because a hedge fund or a credit fund isn't going to sit there and wait 6 months and buy, 20 crore of loans. It doesn't work like that. They need to have a guaranteed kind of income stream, and that needs high throughput securitization. And at the moment, we have this kind of 90-day limit, which is really inhibiting any of that. If you just track how quickly the US and UK particularly, how quickly their markets evolved, it was so linked to the evolution of the securitization market. So I think we will start to see that as DLAI. This is one topic that we have broached the RBI on. We do believe securitization is a very safe way to grow the fintech market, and it's win-win-win, because banks can participate, insurance companies, mutual funds. It can be very, very powerful for investors.
Yeah.
So we have a few questions from the audience as well. Maybe we can take a couple of them. So one question which is raised is, with the rapid growth in retail lending, especially the small ticket size BNPL or STPL kind of products, that too spread across a wide geography in India, how do you manage the collections cost once the portfolio starts having large delinquent accounts? So how are you thinking about managing your feet on street or the other collection models? So we can start with Paddy or Lizzie, and then we can go to Sumit maybe.
So I think, for us, I'm not sure how many of you know, we have a fairly deep branch presence as well, right? So for us, there is an upfront investment in technology, because, if you think about lending, there is origination costs that you can bend by technology, because you can originate at scale. If you have sufficient data, you can underwrite risk very carefully and price risk, as a panelist said, appropriately to the data that you have. And then the third part is how you service that pool of loan. And since we have a deep secure presence in the country, servicing is not an afterthought. You have to bake that in right up front. And all our branches operate with that model where servicing of loans also is upfront, baked into our ROE tree. So I think we are maybe an outlier in this panel in terms of how we approach it, given our secure presence in the Indian market. But to broadly talk about, if it is an afterthought where you originate and you underwrite and hope that somehow you will be able to collect, I think you would be in for a surprise. And Vikram mentioned that people have learned that in the last 2 years very well. But now I'm hopeful most people don't do that. When they start the business, they actually will have a very thoughtful way to collect and service those loans. And to tie it back to some of the securitization point that was made, one of the difficulties in securitization is servicing. So as the ecosystem, as us in the ecosystem, we have to find solutions for not only origination at scale, data at scale, we also have to solve servicing at scale. Right? Because a fund which invests in this is not going to be able to hold on to the assets without appropriate servicing. So I think it has to be front and center when you start a company in lending space. I hope the ecosystem actually comes up with powerful tools to collaborate on servicing.
So I think we have, in the interest of time, maybe Lizzie, Ruchi and Sumit, if you have any different thoughts, etc., it will be helpful if you could put in the chat. Let me move on to the next question. Next was more on the SME lending part of it. So India still has a lot of SMEs who are focused on cash transactions, right? So what's the best way to lend to them without taking too much of risk? Maybe Ruchi, you can share some thoughts on that front.
So I think most of ours is evaluation based on whatever is on books. But one thing is there is what we see. GST has changed a lot, right? There are some sectors and subsectors where there might be cash transactions, etc. We service primarily manufacturing, subcontracting, infra, and core sectors of the economy, wherein an SME is actually servicing a larger B2B entity. And we believe that GST has actually changed a lot in terms of either the data availability or, for that matter, in terms of the transaction. So maybe anyone else on the panel would like to add a little bit more in terms of cash or income estimation.
No, I agree with Ruchi. I mean, pre-2020, when we just started some of the lending versus where we are, if you look at the ratio of GST to banking transaction, it has significantly converged, right? I mean, previously you would have a lot of banking transaction, but not disclosed. But that thing, whatever you call it as BTO, has actually converged quite a bit. So multiple sources of electronic data can actually give you a good estimate of cash flow. And this goes back to if you have more democratized consent-driven data, it's going to solve this problem. That's the only way.
I'll just add that, maybe 5-6 years back, and we saw a slew of SME lending startups which were doing cash flow based lending or alternate database lending, and it ended up being too early for a lot of them. I think today what we are seeing is a whole bunch of data which is suddenly available, and some of it is just sort of a COVID inflection, where almost every transaction is getting invoiced, and even parts of invoices are getting digitized. And that's actually giving you a much more real-time flow on what is happening in a SME. It's a pretty large SME. I'm talking about SMEs with turnovers of crores. So you can now actually really understand what is happening in the flow of transactions of those SMEs. So some of those ideas are coming back, and I think this time around the timing might be better.
I know we are close to the time, but I just want to touch upon one last topic, which is on the regulation side. So last 2 months have been quite active in terms of various regulations and news related to regulations coming up. So I just want to touch upon that. So there is as all of you are aware, there is a recent RBI draft paper on setting up a restriction on FLDG for non-regulated entities. So in your view, is that going to have a negative impact on the lending sector in terms of driving further innovation, or do you believe that this is going to lead to more responsible lending?
I'll let the DLAI president go first.
Okay, let me just clarify, because I think what Vipin's referring to is the working group committee's initial report on their observations of the fintech landscape, which had a number of recommendations. I think it's really important we look at it in the whole. Lots of them we're really, really, really excited and welcoming of. For example, much more focus on customer complaint redressal, customer servicing, all of the really important things that fintechs can do brilliantly and can shine at. As the Digital Lending Association, we already put in place our own code of conduct, which we believe goes over and above everything that's in that document. As Vipin said, though, there's one piece that's causing lots of debate and controversy, which is the reference to first loss guarantee instruments that most fintechs use, or non-NBFC fintechs, i.e. technology companies, operate on an FLDG model with their lending partners. And there's some speculation that will be prohibited. I do believe there will be additional guidance around that entire construct. I would move away from the word FLDG and talk about credit enhancement, because there will always be innovations in the way that we do credit enhancement as an industry. There always has been credit enhancement, by the way, and co-lending, the way that NBFCs and banks traditionally work together, was another form of that. We've been talking about securitization, and all of the instruments around the world, they work on the principles of co-lending or some form of credit enhancement. So we believe that the RBI is very, very deeply aware and cognizant of the risks and the opportunities of credit enhancement, and would like to promote credit enhancement in the industry, but within guardrails that protect the sustainability, the inclusiveness, and really importantly, the systemic risk of the industry. Those three, those sustainability, inclusiveness, and systemic risk, are the key priorities of that panel, of that working committee. And I think that means you will see additional regulation around credit enhancement, which we welcome as an industry. I would just say one sort of generic point on, there's a lot of memes going around this week saying, RBI fintechs, and fintechs are, burning in hell, and the RBI are excited and gleefully watching that. It's so incorrect as a take. Those memes are like exactly the opposite of what I see as DLAI president. We have very, very, very healthy interactions with the RBI on almost a weekly basis. They are probably the most transparent, open, and inquisitive financial regulator on the planet. They are the most aware, well-informed, and I think deeply innovative in terms of their focus. And I think we're really lucky as an industry to have the type of regulator that we have. They are absolutely committed to a sustainable industry that is fair and inclusive to all consumers. And I think any fintech that wants to operate in this country should be, cognizant of that and really appreciate that and look forward to further engagement with the regulator rather than this sort of meme that's evolving that they are, it's us against them. That's actually completely the opposite. And I can say that having worked in other regulatory regimes where regulators are not open, are not transparent, and do not fundamentally understand innovation. We have a very, very, very different environment here, and we should be more grateful and thankful for that environment.
So let me just add, I think we have one of the most progressive regulators in the world. And honestly, I think we couldn't have had this kind of vibrant ecosystem if not for some of the things that the regulator did early on. Right? And I think what the regulators most worry about is systemic risk, as well as making sure they're driving financial services penetration to all. And I think the most important things, 2 points that I wanted to make, even for some of our youngest, I think a dialogue with the regulator saying, this is what I'm going to do is actually going to be well received. And I would encourage every fintech to go out there and do that. Instead of saying, you know what, I'm going to keep doing stuff till I get caught. And, then that's too late, because then from a regulatory perspective, you're a bad market participant or a bad market actor. So even at young stages, I know it can slow you down, but it is actually well worth that time spent. And I think there's now enough windows with the regulator where you can go and have an open conversation. And I'm telling you, almost all of our companies have been able to figure out that window. And there's enough people in the ecosystem who can point you to that window and you can have that conversation. Encourage everyone to go out there and do it. Second, and this is more a plea to the regulator, which is, I understand when that systemic risk crops up, then it's like a blunt knife, which is a one size fits all. And I think that's where there is a conversation around innovation versus regulation, because I absolutely know that the regulator doesn't think innovation and regulation are at loggerheads, and neither do any of us. But I think when it becomes a one size fits all, I think we do end up stifling innovation for some of the smaller companies. And I'd love to see, at least I for one would love to see how, just the way, there are systemically important NBFCs which are measured by a different yardstick. I think, and all of you guys are now getting to that scale or higher. So you do need to measure those companies with a different yardstick, and they need to subscribe to much higher scrutiny. And maybe some of the smaller ones, you have to let some innovation thrive and let the balance sheets that they are working with sort of drive some of the compliance and governance.
No, absolutely, Vikram. I think when we spoke to most of the founders spoke about having a more responsible lending rather than worrying about regulations, because they felt that these regulations actually lead or at least encourage most fintechs to be responsible in the way they do operate, right? And I think like one point which you mentioned specifically, I think I like that point. While we think about regulations, I think we need to think about larger sandboxes, wherein maybe the smaller fintechs, until they achieve a certain scale, let's be 50 crore AUM, they can be allowed to do innovation. But you can't operate at 1,000 crore AUM and still not have no regulation or no responsible way of doing things, right? So I think
I just wanted to add this stuff and just completely echo what Lizzie said around the regulator actually being very informed. I don't know, many of us don't even talk about it. The regulator actually has a regulatory sandbox. They actually had 3 cohorts and they just launched the 4th one as well, right? Wherein the innovators, the fintechs and regulators can actually do field testing of some of the new financial innovations. I think a lot of people, the news, the media actually just has picked up the word FLDG as to what Lizzie pointed out, that things have to be looked at in a more holistic way. Maybe it makes the headlines and it leads to interesting cartoons, etc. and memes. But the fact is that in totality means I know when DHFL went down, everybody was so knowledgeable about ALM. people didn't even care about ALM, and many people didn't even get to know what really ALM is and ALM mismatches, but everybody's like, ALM, oh my God. I mean, I think there is a lot more to the financial services ecosystem. There are a lot of things networked and put together, and just wanted to just maybe we talk about positive things also as much as to what the regulator is doing for either the systemic risk or the sustainability, as to what Lizzie was saying. So I think those things don't get talked about as much. So just wanted to put that point.
Yeah. So I think we are almost 5 minutes past 6 o'clock. So maybe I will close it now. So I think for me, there are three key takeaways from the whole discussion, right? First one is, I think the cost of funds or the debt market is one of the key reasons or most important lever for fintechs to target the right set of customer segments and manage the portfolio quality. Second is, I think scaling is, or achieving a certain scale becomes very, very critical for most of the fintechs to manage the OPEX or the cost which they have already invested in. And the third one, I think, which is I think against the notion most of us have, that portfolio quality is of utmost importance for fintechs, and that's top of mind for most of the founders in the fintech ecosystem right now. So I would say these are three key takeaways for me, at least. So I want to thank you, all of you, for taking time out, and I'm sure all of you are a very busy schedule, and thanks for doing that. And I also wanted to thank, I think we had close to 200 plus participants today, which is a very great outcome. So I wanted to thank each one of them for taking time out and attending this. That's all from my side. Vikram, anything you want to add on the subsequent panels?
I think we're going to do a bunch of these. Firstly, thank you to all the panelists and also the BCG team for putting all of the deck and the hard work together. I know it's taken a lot of people behind the scenes to do it. We're going to continue this discussion. I think the next one is around new banking. So look out for the next slot on the social media feed. And obviously that's a hot topic, and hopefully we'll have some interesting insights to share there.
Thank you.
Thank you.
Thanks,
Thank
everyone.
you. Bye.